Welcome to House Lux Estate, where we help you unlock the true potential of your investments. Here at House Lux Estate, we strive to provide you with the insights and strategies you need to make the most of your assets. We're all about empowering you to take charge of your financial future. Today, we're diving into an essential topic, making your portfolio inflation resilient. Stick with us and we'll walk you through every step. In the next few minutes, we will break down the process of making your portfolio inflation resilient. First, let's demystify inflation. What is it and why should you care? Inflation, in the simplest terms, is the rate at which the general level of prices for goods and services is rising, and subsequently purchasing power is falling. Think of it like this. If a cup of coffee costs $1 today and the inflation rate is 2% a year from now, that same cup of coffee will cost $1.02. It's a subtle change, but it's there. Now, you might be wondering, what does this have to do with my investments? Well, it's all about the purchasing power of your money. When inflation rates rise, every dollar you have buys a smaller percentage of a good or a service. It's like a silent thief, subtly eroding the value of your money over time. Let's consider a real-life example. Imagine you've stashed away $10,000 under your mattress. After a year, with an inflation rate of 2%, the purchasing power of your $10,000 will have reduced to $9,800. That's $200 lost to inflation. This is particularly important for investors, as the goal of investing is to grow wealth over time. If your investments are not keeping up with inflation, you are effectively losing money. For instance, if you invest your money in a savings account that yields 1% interest annually, but inflation is running at 2%, you're actually losing purchasing power. Your money isn't working as hard as it could be. Inflation can also impact the broader economy, influencing interest rates, property values, and stock prices. That's why understanding inflation is vital to making informed investment decisions. Now that we understand inflation, let's move on to how it affects your investment portfolio. Inflation can erode the value of your investments. Let's see how. In the world of investing, inflation is like that pesky termite that silently and gradually eats into the value of your money. Let's illustrate this with some types of investments. Consider stocks. Companies may pass on the increased costs caused by inflation to their customers. This leads to increased revenue and potentially higher stock prices. However, if a company is unable to do so, its profit margins may shrink, leading to a decrease in its stock price. Now let's talk about bonds. Inflation is particularly harmful to bond investors. Why? Because they receive a fixed interest rate. If inflation rises, the purchasing power of the fixed income from bonds decreases. Real estate investments, on the other hand, can offer some protection against inflation. As inflation causes the general price level to rise, it can also push up the prices of properties, and consequently the rent landlords can charge their tenants. So, what happens when you take inflation into account? You get what is called real returns. This is the return on your investment after adjusting for inflation. You may think you're making money if you look at the nominal return, which is the return not adjusted for inflation. But when you account for inflation, you might be in for a surprise. For instance, if you invested in a bond with a nominal return of 4% and inflation was at 2%, your real return would be only 2%. Now imagine if inflation jumps to 5%. Your real return turns negative, even though the nominal return is still positive. This is how inflation can turn your positive nominal returns into negative real returns, eating away the value of your investments. With inflation chipping away at your returns, it's crucial to make your portfolio inflation resilient. But how do we do that? Stay tuned as we delve into strategies in the next scene. There are several strategies to protect your portfolio from inflation. Let's delve into them. Inflation can erode the value of your savings and investments. But by using a few simple strategies, you can make your portfolio inflation resilient and protect your hard-earned money. One of the most effective ways to safeguard your portfolio is by investing in assets that tend to increase in value with inflation. This is where real estate comes in. Real estate has long been viewed as a hedge against inflation. As the cost of living increases, so does the value of properties and the rental income they generate. This can provide a steady stream of income that keeps pace with inflation. Additionally, commodities like gold, oil, and agricultural products also tend to rise in value with inflation. This is because their prices are often driven by supply and demand dynamics, which are directly impacted by inflation. Another strategy to consider is investing in inflation-protected securities. These are government-issued bonds that adjust their payouts based on changes in the inflation rate. In the United States, for example, Treasury inflation-protected securities, or TIPS, provide a guaranteed real return that is adjusted for inflation. This can be a smart way to protect your portfolio from the eroding effects of inflation. Diversification is another key strategy in making your portfolio inflation resilient. This involves spreading your investments across a variety of assets and sectors. By doing so, you reduce the risk of any single investment significantly underperforming due to inflation. This can include a mix of stocks, bonds, real estate, commodities, and cash. The idea here is not to put all your eggs in one basket. It's also worth considering global diversification. Investing in foreign markets can provide a buffer against inflation, especially in countries where inflation rates are lower than your home country. However, remember that investing in foreign markets also comes with its own set of risks, such as currency risk and geopolitical risk. So it's essential to do your homework before investing abroad. And finally, don't forget about the power of compounding. By reinvesting your returns, you can generate even more returns over time. This can help your portfolio grow at a faster rate than inflation, preserving its purchasing power. These strategies can help you make your portfolio inflation resilient. However, it's important to keep in mind the overall market conditions and your personal financial goals. Each strategy has its own set of advantages and potential drawbacks. It's essential to carefully consider your individual financial situation, risk tolerance, and investment goals before making any decisions. And remember, making your portfolio inflation resilient is not a one-time event, but a continual process. So, keep a close eye on market trends, adjust your strategies as needed, and seek professional advice if necessary. And to wrap up, let's revisit what we've learned today. We began by exploring the concept of inflation, which is essentially the rate at which the general level of prices for goods and services is rising. It's crucial to understand that inflation gradually erodes the purchasing power of money, meaning that a dollar today won't buy as much in the future. Then, we delved into how inflation impacts your investment portfolio. When inflation rates rise, the real returns on investments can be significantly affected. In other words, you may not be earning as much as you think you are. This is why it's not just enough to invest your money, but you also need to ensure that your investments are outpacing inflation. This led us to discuss strategies to make your portfolio inflation resilient. Diversification, an age-old investment principle, remains key. Spreading your investments across a variety of asset classes can help mitigate the risks associated with inflation. We also talked about investing in assets that historically have demonstrated a positive correlation with inflation. Real estate and commodities like gold are prime examples. They have the potential to appreciate in value as inflation rises, helping your portfolio retain its value. Bonds, particularly inflation-protected securities, can also play a vital role in an inflation-resilient portfolio. These securities are designed to help protect investors from the eroding effects of inflation. And finally, we emphasize the importance of staying informed and vigilant. Keeping a close eye on inflation trends and adjusting your investment strategy accordingly can go a long way in preserving your portfolio's value. Remember, inflation isn't necessarily a bad thing. In fact, a moderate level of inflation is a sign of a healthy, growing economy. But as smart investors, we need to ensure that our portfolios are resilient enough to withstand its effects. In conclusion, making your portfolio inflation resilient is not a one-time task, but a continuous process. It requires a good understanding of inflation, a well-thought-out investment strategy, and the willingness to adapt as market conditions change. Thank you for tuning in to House Lux Estate. Don't forget to subscribe for more insightful investment advice. Remember, the key to a successful investment is staying informed and making smart decisions.